Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to J.P.Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. On the podcast this week, I have a chance to talk to Georgina Brittain, who has been managing what is now known as the J.P.Morgan Smaller Companies Growth and Income Trust for getting on for 3 decades. I think I can say that, Georgina, without correction. It's been a long haul, and you've seen pretty much everything that can happen in the equity markets over that time. And here we are again. This week, good opportunity to catch up with you. I'm going to start, if you'll forgive me, with just a comment on the political situation. We've had a new Prime Minister this week. I can't remember if it was our 6th or 7th or something in the last decade. And he's come in and already made a few announcements. I guess when we spoke 2 years ago, you were disappointed by the initial policy actions of the Starmer-Reeves government. And I think a lot of people have shared that view since. What are your hopes about Mr. Burnham, what he can do for the country and what he can do perhaps more relevantly for smaller companies in the UK equity market?
Well, first of all, hello, Jonathan, and thank you very much for inviting me back on your podcast. So, yes, I remember that well, and then sadly, we were all proved right 2 years ago. It's very much far too early to say, too much, obviously, about the current government, except, the thing that we were most concerned about was, this is not a surprise, it's not clever, but who the Chancellor was going to be. So we were very pleased with that choice. So far, so good, 5 days in. When we talked 2 years ago, the concerns for us, obviously, with our corporate hats on, were the national insurance tax, the very significant increase in minimum wage, etc., with the obvious knock-on effects on corporate earnings. That's one thing, but on hiring impacts, growth impacts, investment impacts, all of which, sadly, have proven to be true. So it sounds so glib, but the one thing that we're looking for, because companies are looking for, in order to run a company of pretty much any size in this country or anywhere in the world, what you're looking for is just stability. You just want to know what the ground rules are. And then guess what? You get out there, you make your widgets, you produce your clever kit, whatever on earth it is you do, knowing that there's a backdrop that you can kind of rely on, that you're not going to have horrible surprises coming out of the woodwork. So that is absolutely the key. It's a lot easier to say than to do. The other key for the UK in particular, and I think we've had a little bit of positive news today on consumer confidence. I'm talking a little bit. We're not a very confident country at the moment, but anything that can be done, and some of the measures we've already heard from Andy Burnham seem to be heading in this way. We know our economy is driven by the consumer. It's 2/3 consumer related. So, it's so easy to say, obviously not easy to do, but really the two things we're looking for are really provide stability, a stable backdrop for companies to get out there and do their own thing, but also provide some comfort for the general public. Basically, we don't want them to think about politics. We don't want them to ever have to think about it. And that's just not been true, well, pretty much for the last decade since the Brexit vote. So again, what we really hope for is we get onto that stage.
Well, one of the damaging things about the Labour government when it started 2 years ago was that there was this long interim period before the first budget, and there were lots of rumours, none of which were particularly helpful, and then came some measures which weren't helpful either. We've still got to wait until we hear the first budget under Andy Burnham. We've heard 1 or 2 smaller measures around the margin, which I think, as you say, may help to boost confidence, and certainly the kind of general tone of Andy Burnham is much more positive than we heard from Rachel Reeves 2 years ago, that's for sure. So I guess we'll take those as positives. But fundamentally, of course, a lot more needs to be done. The UK equity market has been cheap and unloved for a long time now. Every time I talk to someone like yourself, and particularly those who manage small cap funds, it has been the same story, which is it's desperately cheap compared to lots of other markets. It's very cheap compared to history. And yet nobody seems to want to come and buy things, except for companies and private equity have been picking up quite a lot of things through M&A, and that's helped to keep the market afloat. Do you see that changing anytime soon? In other words, from looking at your share register, talking to the investors who might be investing in your trust, do you see any sign of any significant return to buying of UK equities and small caps in particular, notwithstanding how cheap they are?
Well, am I seeing it right now? The honest answer is no. But I will say that at least twice in the last 2 years, when it appeared that there was some sort of stability, the most recently being at the start of this year, when my colleague who co-runs the fund with me, Ketan and I were talking, start of January this year, we were honestly pretty excited about life in our area of the market. And what we were looking at were just, again, big backdrop. So we were looking at interest rates coming down, inflation coming down, all of that good stuff, which definitely would be very helpful for getting investors to look lower down the market cap scale, because we're so UK focused, our area of the market. And then, of course, Trump went to war and that all got blown to smithereens. But during that stage, when it started to look good, we were out marketing our little socks off. We were getting incoming calls. My guys in the office who produce all the packs and everything were really busy. And we've seen that twice in the last 2 years, which shows that it's on the radar and then something happens. So I call myself a cynical optimist. You've got to be optimistic in order to do what I do, as far as I'm concerned, to invest, to believe in companies, believe in their growth, believe in their story. But you've also got to be cynical, always asking what's going on. I mean, I'm a bit bored of being cynical about the world at the moment, because that's the real hindrance from where I sit.
And you're right, of course, that President Trump has twice now lobbed a hand grenade into the market, so to speak, and he may be doing it again by reinstating tariffs. I think that's not a total surprise, and that's not necessarily particularly helpful if you're an exporter in this country. But just on the valuations point, like a lot of fund managers, you put out regular charts showing, how the valuations compare. Well, if we look at UK small cap, I think it's on a forward PE of around, 13 or something like that across the market, according to your last presentation. But I believe it's also the case that in your portfolio, it's a bit lower than that, isn't it?
No, absolutely. So the two key metrics we look at in terms of valuation are the humble PE. And as you say, we've actually got a portfolio which collectively is cheaper than our index. So I looked yesterday, we're sort of about 11.5. But also the other crucial metric we look at is free cash flow yield. So this is the cash that a company produces after having done all the spending and paid tax and all of that good stuff. And we look at that on a historic basis because it's factual. Of course, there are forecasts in the markets. And our trust is pretty close to 9% historic free cash flow yield. That's a trust. That's a group of circa 80 companies handpicked by Ketan and myself that we think have good to extremely good outlook and momentum. And you can buy them on that kind of free cash flow yield. That's not right. As you said at the start, I have been doing this an extremely long time, and this is not normal.
Indeed, it is not. And I guess the challenge, though, is that these companies, a lot of companies are generating a lot of free cash flow yield, as you say. But are they reinvesting it or are they hoarding it? Quite a few are doing share buybacks, I know. What's the experience across your portfolio?
That's a very good question. And it's a little bit mixed. So in general, they invest. That's why we invest in them, because we look at things like, the returns they get on their investment. So the ROIC. And de facto, our companies are small and should be growing. And in order to do that, obviously, you need to invest. So we're very keen on that, just as a type of company. We talk to our companies. We encourage all of this. And in general, they definitely are still investing. What's interesting, again, if I hark back to quite how long I've done this, if I rewind, I don't know, probably a decade or something, in the smaller cap area, so really, going down the market cap scale, I used to be pretty adamant about not doing buybacks for our companies. So, as one shareholder, I would give them our views of what we thought about buybacks and was pretty vehement about it. And I said exactly that. No, two reasons. One, I want you to be spending that money, investing, getting the returns. And number two, again, in the bottom end of the market with small companies, you have to think, and one has to think about liquidity. As an investor of our kind of size, my kind of size, with my kind of scale, can I get into a company? Can I get out of it and stuff? And, I'm not alone in that. A lot of other fund managers will very much focus on liquidity too. So I was very concerned that, A, I wanted companies to invest for its own sake, and B, I was concerned about the liquidity implications. I have completely changed my tune for not all companies, but really a lot. Because once again, and I'm going to mention this a lot, we're going to mention this a lot on this podcast, but just because of where valuations are. And at this point, for some companies, and again, not all, I'm literally saying to them, I can't think of anything more productive. And I really mean that in terms of financially more sensible than you buying back your own shares at this valuation. It's the best return you can get, which is a terrible thing to have to say, but it's true. But it's true. It also does tell you, I mean, I've talked already quite a bit about cash, as in free cash flow. The fact that a lot of our companies are choosing to do both so they can afford to do buybacks and still continue investing just tells you what a good place these companies are in. Forget the valuation, the fact that no one else wants to look at them and whatever. If a company can afford to do both and should be doing both on this kind of valuation, that is a real positive.
Well, that's good to hear, a positive. I'll come back to that if I may in a moment. My next questions are going to be, obviously, a couple of years ago, you merged the J.P.Morgan smaller companies and the mid-cap trust into a single entity, larger company as a result. If I look at your portfolio today, would I essentially be recognizing the smaller cap trust that I knew before, or would I be actually getting a mixture of small and mid-cap? In other words, has that profile of your portfolio changed significantly since the merger?
Great question. And the absolute answer is no. You would be seeing basically our smaller companies investment trust very much. And we still have the same benchmark. So that kind of proves it. But absolutely, that is the case. And Katan and I were adamant that that's what we wanted to do. And if I can possibly preempt a question that you're very likely to ask. So one of the key changes post the merger was in terms of income, the income we pay. So in the past, for our smaller companies investment trust, basically we paid out any income we got. So it turned out to be quite progressive because, as I say, our companies are handing out more and more cash, but it was a byproduct. So now what we say and what we do, our year end is the 31st of July, so imminent, and we take the net asset value on that day and we pay out a 4% dividend. We pay it quarterly, so it's 1% per quarter. And for the year, that is set in stone from the year-end net asset value. So at the moment, in fact, we're slightly yielding even more than the 4%. We did that for various reasons, but largely because in addition to obviously our institutional shareholders, we understand, and J.P.Morgan obviously manages a lot of investment trusts, and they've done this with quite a few already. And it is proving to be pretty attractive to retail investors. So you can see all that. But the most important thing about this, because again, Katan and I were a little perturbed by this, and absolutely what we do, how we run this investment trust is exactly the same as it always was. So we don't focus on income. Great if companies are giving us income, paying dividends or special dividends. But if we need to pay a portion of that income out of our reserves rather than income we've received, we absolutely will. So in no way does that restrain us or constrain us from anything that we want to buy or sell. And that's absolutely crucial.
So obviously the FTSE 250 index, which is most people regard as sort of mid-cap area, has also performed very poorly. But your benchmark is the Numis Smaller Companies plus AIM index. I wonder what your thoughts about AIM are at the moment. I mean, it had a wonderful period of about 5 years when AIM did very well, and the last 5 years or so have been very poor. So to the extent you track the benchmark, has that effectively dragged down your performance at all? What is the percentage you have in AIM, and what do you think about what's been going on in AIM, where obviously one of the changes has been a partial loss of some of the tax advantages for companies that list there?
Absolutely. I tell you what, I'm just going to look up the AIM percentage in a moment. But what is interesting, when you were talking about our benchmark and when you kind of talked about our mid-cap investment trust and our smaller companies investment trust, when we had the two, our Numis plus AIM index, which is the bottom 10% by market cap of the market, the largest company currently is circa 2.8 billion. So this index now, for a whole lot of reasons, actually does cover really quite a lot of mid-cap as well. So that's a point to make. So we've definitely got much more mid-cap than we used to, but that's because that's where the index is taking us rather than anything else. So as we know, AIM was sort of in the firing line, really, was seen to be in the firing line by Rachel Reeves. The outcome was not as bad as feared, but definitely we saw two things. So we saw AIM underperforming during all that period. But what we also saw was a number of companies moving away from AIM to the main market. And that's definitely ongoing. I mean, one of our holdings is literally sort of in the middle of it. And then you get announcements probably, I mean, less now because so many have done it already. So what's interesting, AIM is now circa 20% of the benchmark. Used to be 26, 27, literally sort of a year ago. And we were overweight in AIM at that stage, and we're now underweight. I should just say, for us, the backdrop of the noise about potential impacts by the government was very unhelpful. But in general, and this is going to sound bad, I don't want it to be taken that way, but most of the time, we don't even know, we can't even remember if a company is main market or AIM. We don't care. We're invested in the company. We don't care which market it's on. So for us, when they make the move over, that makes absolutely no difference. But we just see it at the moment definitely continuing to shrink.
Well, I suppose there may be a risk that they'll do more on that front, but do you think they may have noticed that it hasn't gone down particularly well so far?
You'd like to think so.
You'd like to think, but you never know, do you? If we look also then at the performance of the trust over recent periods, small cap is always volatile. It's been particularly volatile. Looking at the Morningstar numbers, and they have you down as a 3-year annualized return of 13%, which is about 6.5% ahead of the peer group. Over 5 years, 0.28%, so roughly zero. And then over 10 years, 12.1%, also about 5.5% of the peer group. They're obviously not quite tracking the index in every case. That's a pretty volatile ride, eventually, is what you've been through. Do you think it's been more than usual volatility? In other words, I see, according to Morningstar, you still have a positive Sharpe ratio, which adjusts for the volatility. But how does it feel to you? And what do you say to people who are investing in small cap, other than it's for the long term? Stupid.
Well, I definitely do advise that. And I hope, and I like to say, I always have done it. Let's be very clear. But it's quite shocking, isn't it? As you say, basically flat on 5 years. But if you think about the decade we're talking about, it did start with the Brexit vote, then the actual Brexit, ignoring politics, totally put it aside. Then we had COVID, then we've had the invasion of Ukraine, and now we've got a war in the Middle East. There's a lot going on there, but I know all of that could be said of the US, which has obviously continued to go gangbusters. But for us, you kind of live through that. I mean, hopefully never again something like a COVID, which hopefully was absolute one of. But what we're really noticing is individual stock volatility on a daily basis. And I'm going to say this is probably about the last year or so. This has gone up really notably for us. And great when you own the stocks, not so good if you don't, kind of thing. But I mean, and it's definitely both ways. So today's a fairly quiet Friday and near the end of July, but pretty much every single day there are stocks in our world, in our universe, that are up 20 to 30%, not on bids, just because. And likewise, there'll be stocks that are down 20 to 30% on a day. And it's been coming, but it's definitely a feature now. My view is that this remains a feature forever. This is now how it works. So we've had to try and not adapt really, because we have a process, we have a thought process, we know exactly what we're looking for in companies. And if they disappoint us, our approach almost always is just to exit, take the money, less than it was yesterday, but take the money and reinvest into something that's going to make our shareholders money. That's really just how we think. But given this kind of volatility, often for really, truly no reason. So, we'll look at a holding that we have and it's down 25% over the last 2 months. On nothing. The company hasn't spoken. There's been no news flow. So we're trying to adapt in that sense of companies that we really like. Obviously you go away and check that we haven't missed anything, which is pretty unlikely. And then you have to learn to take advantage of it. So you just say, this is wrong. This share price is wrong. In fact, it's even more attractive than it was when it was 25% higher and I still really liked it. And you got to go and buy more. So you must try to make it your friend, this volatility.
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. You mentioned the M&A activity, and obviously we know there's been quite a lot, and you benefited from that in some cases. Do you think that trend is slowing, increasing, or just more of the same? And do you think that the premiums you've received, you obviously received some handsome ones and some not so handsome ones, actually do reflect whatever you like to think the intrinsic value of these companies are?
Okay, so lots of good questions in there. So I will tell you, absolutely, there is no stopping this at the moment. I mean, I think it was actually last week, there were 3 announcements on one day. And what's been more interesting, we've been partially benefiting and partly suffering. The smaller cap area of the market has very much been the focus. That's really started to change in 2026. So, now we're getting FTSE 100 names also going out of the index. So that's kind of interesting. It's really not a small cap phenomenon by itself anymore. I would just say very specifically for this year, 2026, luckily I'm talking to you today because if I'd spoken to you last week, we've had 2 sort of little approaches, which sort of came and went. So nothing to see there, but not had a proper bid for this entire calendar year. And then, thank goodness, we got one this week. And this starts to matter because there's so many of them that you don't own a stock and it goes up 40% on the day. It's a painful day for you. So we absolutely don't, because we don't believe we can, own stocks or focus on stocks that we think are going to get bought. That's a nonsense. But as I say, and this is absolutely continuing. And it is, as you said, it's PE, but it's also trade. There are a lot of people out there looking at these valuations and finding them extremely attractive, even post the premiums. So if I look at a few that we benefited from, so last year, it's very interesting. There were some really nice premiums. So we owned, for example, Just Group, which PE bought, which was a 75% premium. So that was a nice day. Then we also owned a lot of Alpha Group, used to be called Alpha FX, and that went for a 55% premium. It was not the cheapest company, full stop, so we were quite pleased with that. We've had a couple which are literally the sort of round about the 30% number. There's 2 things on that. One, we weren't that happy with how management was managing the company, but the valuation meant we couldn't bring ourselves to sell it. So when we got a nice premium on the day, we were just happy with that. That's pretty rare for us. But some of these, well, in fact, it's interesting. I'll actually name 2. So I've already talked about Alpha Group and also Renault. So Renault, we also got a 50% premium for that bid. So both of those 2, we think we know these companies quite well. And neither of them were we at all sure that the valuation, I mean, that's great on the day. That's fantastic. But it was like, wait a moment, would the company get there anyway? And those are the questions we asked. And sorry, just to interrupt myself, categorically, we say no if we don't think the price is reflective. But both of those for different reasons. So Alpha Group, the founder was still very much involved. He had been the chief executive till about a year prior, and we knew him well. So we spoke to him, and he was adamant. He had recommended his portion of shares, which is extremely important for the bidder. And in the discussions with us, he said, as I say, he'd founded this company. He built this really impressive company, and he had found the right home for it for the future. And that's where he wanted to go. So he was completely comfortable with that price. That's really useful information for us. So we said, fine, great, we'll take the money and we're all well. Renault was really interesting in a different way because, well, actually it was PE who bought that. But this was a company that was loathed by the stock market and on a really silly valuation. And when the bid came along, as I say, it was 50% premium, we had a look at it and it's like, again, on the day, you feel good. That's a very nice event to have happened. But actually, when we still looked at the valuation that they were paying, I was like, well, wait a moment, is that far too little? Honestly, we were talking amongst ourselves, should it be 100% premium? We voted with on that one as well. So we accepted the bid. And that was really interesting because the chief executive, who we'd known for 10 years, who slaved away for 10 years, he wrote really interestingly on this. So it's all online about why basically the UK quoted market wasn't the right place for this company in order to do what they wanted to do. And it was quite a sad message for a company like this, but it was very clearly valid. And so we accepted again. So there's good and bad on some of these takeovers. But as I say, in general, for us, the crucial thing is if we're not getting minimum tomorrow's price today, then we'll reject it. And I would just say on this, I've said this a couple of times, I have been known, and a couple of years ago, I was telling a lot of our companies, some are not quite as cheap as they were, but we talk to our companies about this when there are no bids on the table. So, I have definitely sat in front of a number of chief executives and I've told them really, truly, if you're starting to get bids, which is happening all over, I don't want you, me personally, and we can maybe be a 5, 6, 7% shareholder. So I'm like, obviously consult with your other shareholders. I'm never going to tell you what to do, but I'm giving you my view. I said, I don't want you to even engage in any conversation with any potential bidder unless we're talking about 100% premium. And I've actually said that to them and meant it. That's the disconnect that we see in some of these valuations.
Last year, you report there were 31, I think, M&A deals in the UK. About 70% of those were corporate and 30% were private equity or financial buyers. Which is a polite word, I suppose, for that activity. Do you have a preference between those two? I mean, do the companies understand the company is better than private equity or vice versa, do you think?
You know what? I'm going to say the honest truth. I always say the truth. If a company, one of my holdings is being bought, and I'm obviously getting cash, not shares, me personally, as in the fund manager who owns the shares, I don't care who buys it. That may be a bit callous, but what I care about is the price you're paying, and I don't care who you are. That's why the example I gave you about Alpha Group was very interesting, because that's how we think. Of course we do. What we're getting is hard cash in hand and a company that no longer is around for us to invest in. Alpha Group, the example I gave was the founder was still very much involved. He, of course, cares hugely about the people and the future of that company, as he should do. And, those are not incompatible, but you get my point. I don't care.
Okay. I was sort of trying to ask whether you think that one of those two groups has a tendency to pay more or to be more optimistic, but I guess you could say that's true of both categories, because you have empire builders and CEOs who want to buy things and pay too much for them, and you have private equity who may or may not pay too much for them because they're going to use leverage and so on. So I guess you can argue it either way. Talking of which, in terms of gearing, I mean, you've been notable, I think, as a fund manager, or the trust anyway, as having a fairly consistent level of gearing. I mean, you believe in gearing as an investment trust structural option, but it does vary, obviously, from month to month and year to year. What has been the pattern over the past, say, year? And is that actually influenced by whether expectations of cheaper money turn out to be justified or not, which, of course, they haven't been so far?
No, sadly they haven't. And that will, of course, be a part of it. But really, for us, I say, what did I call myself? A cynical optimist. We believe that markets are too cheap and should and will go up. And therefore, because of the setup of the investment trust system, we like to have gearing on top. And over the years, that's proven to be very much the case. What we absolutely don't want to do is have the tail wagging the dog. Back in the day, people used to have a lot more gearing than one generally sees now in the equity market. And I think that's fair. I'd hate to underperform because we had gearing when the market went down. So kind of for us, it almost is that simple. So for us, circa 10% is the number we're comfortable with. We'll definitely bring it back if we need to. But much more what you see in terms of the movement in our gearing is literally us buying and selling shares, or, of course, having a takeover. So some of these, as I said, they can be 4% of the portfolio. So the day you get the cash, or occasionally we'll sell early to get the cash early, that's a 4% move in your gearing before you get to reinvest it. So there's a lot of noise, but if you look kind of underlying, circa 10% is the number we feel is additive enough. And we're happy to take that risk, but it's not too risky.
Can I just ask you, without talking too much about specific names, because that's not really our role here, you do the stock picking, but if you look at the kind of sectors you're involved in terms of their active positions, I'm just looking down, you've got construction materials, you've got industrial support services, food producers, banks, and software and computer services are the main overweights in the portfolio. Does that tell us anything about the style of your approach, whether that's changed at all since the merger, and whether or not you are, as it were, a growth or a value investor at heart? Everybody's a value investor at heart, but do you have a particular style? Or is the function of the trust essentially, it's a £400 million trust, it's trying to pick up anybody who wants to invest in small cap as a sector, so without taking a strong value or growth bias? How would you describe that?
Okay, so lots of questions in there. So first and foremost, what we do and what we are is we're stock pickers. So the sector overweights and underweights that you were just talking about are literally a byproduct. Of course, we keep an eye, we have a look, and we're aware of potential risks, etc. But really, truly, this is about stock picking. In terms of how we run money, so we have a process and a philosophy which we utilize in order to make our investments and divestments. And internally, we call it VQM, so value, quality, and momentum. And that tells you really several things, but value is part of our mindset. That doesn't mean we can't own a company because we think it's too expensive. If it's got the growth and all the right characteristics, then it deserves a premium to a lot of other companies out there in the market. That's kind of the approach on that. But as you said, in terms of PE and also in terms of free cash flow yield, we do have a tilt towards cheaper companies than our index. But really, truly, I mentioned momentum, and that will be price momentum, but also very largely for us, it's about earnings momentum. We want to focus on companies that are doing better than expectations, theirs and ours. But again, if you think about our area of the market, guess what? Smaller companies, which ideally will grow and get into the FTSE 100, growth is definitely part of the agenda. So I think we're kind of more balanced than some of our competitors out there. We think it's right. But as I say, at the end of the day, growth, preferably growth in share price, but growth in company is really what it's all about. And, over the years, we've had several companies that we bought at 200-300 million market cap that are now in the FTSE 100. That's what we call growth.
So finally, then, let me just give an opportunity just to sum up why should people look at your trust in particular. There are a lot of small company trusts around, not as many as there were, but there are still quite a few left. One of your long-serving peer group is just announced he's retiring next year after 38 years, I think it is. I'm talking about James Henderson, who covers the whole market, not just smaller cap.
No, I hadn't heard that.
Yes, he's going to retire next year, but he's done 38 years. So that means if you do the same, you've only got another 10 years to go. I just wonder what... talking about your trust, why people should look at your trust. In an environment where we've got uncertainty about the government at the moment, we've got interest rates not coming down as people hoped, we've got Donald Trump throwing his weight around in not always helpful ways, but the UK economy is sort of pottering along. I think we can say that. It's not shooting the lights out. What is the case for putting money into small cap and into your trust in particular?
Okay, you're putting me completely on the spot. So I am going to start and end with valuation. I was told this a very, very long time ago. What you do, what your job is to buy low and sell high. But you have to start with the buying low in order to make the money. This has come up a little bit in our conversation, but when I say the valuations that we're seeing for a lot of names are abnormal, I mean they're extraordinary. And I don't say that lightly. I say that with 30 years of experience. So buy low at some point, you can sell high. For us in general, so I think I've touched a little bit on our process, how we think and how we invest. But the point is we actually have a process. We absolutely follow it. We don't veer. Obviously, like any kind of process, it won't always be in favour. But absolutely, you'll never see us changing from it because over time, it's absolutely proved itself. And I think we're allowed to talk about track record, and I'm allowed to talk about track record here. So as you said, this is 30 years of track record I have. It's quite a good one. So I would definitely emphasize that. And then lastly, definitely for retail, income is becoming just so much more important for everyone, as we said, and corporates included. And on top of all the upside that one likes to imagine is going to happen in the small cap world, you're getting a 4% income. The other thing I should say on this, one of the things that we talk about, Tan and I, when we're marketing is, well, the first thing is I'm asked almost every single meeting, what's the catalyst? And I've actually turned around to a few people who I do know quite well and said, you're the blue bean catalyst. You're the catalyst. When money starts coming into this market, and I've talked a little bit about liquidity, guess what? Prices start to go up. Guess what? More money comes in. Guess what? Prices carry on going up. And we've seen this, and I've seen this, over the years in the past. And when it goes up, this area of the market really can roar, and that would be the right word. The movements are astonishing. So get in now, be ready for the roaring.
Well, that's a splendidly positive note on which to end. So thank you very much. That was Georgina Brittain, the co-manager of the J.P.Morgan Small Cap Growth and Income Trust, now paying an enhanced dividend of 4% a year. And the ticker there is JUGI.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by J.P.Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.